Welcome back to the deep dive. We are jumping straight into the source material you provided, and it really paints a stark picture of what's happening in crypto right now.
Stark is a good word for it. It's an intense moment. We're not just looking at a little bit of volatility here.
No, not at all. This is a full-blown market stress test,
Hmm?
and we're zeroing in on Bitcoin, specifically around this November 21st trading session.
Exactly. And the sources we have, they're not just opinion pieces, they're professional grade technical reports. They're blending the hard data, moving averages, RSI levels, with the really crucial psychological stuff.
Like the Fear and Greed Index.
Right. And what we're seeing is this weird paradox. The market is moving in a very mechanical, predictable way based on the tech, but the sentiment underneath it all is just completely broken.
And that paradox is really the core of what we're tackling in this deep dive. The market is flashing extreme fear, right? Which, historically, can be a huge buying opportunity.
A generational one sometimes.
But at the same time, all the technicals are screaming that we are in a strong, sustained downtrend.
Which opens the door to that dreaded bull trap.
Exactly. So the mission is to distill this down. Is this extreme fear signal the real cycle bottom? Is this the moment to act?
Or are we just seeing a temporary bounce, a little bit of relief, before a much deeper fall down to those critical support zones? We're talking, what, 78K, 82K?
It's a moment of, maximum risk, but also potentially maximum reward.
It is. And I think the key here is to stop looking at these indicators in isolation. You can't just look at fear or just look at RSI.
You have to map the confluence.
You have to. When the technicals for a rally smash right into the structural reasons for a collapse, that's when you have to understand the pattern they're talking about, the Hoyure model.
The relief rally and the fall that comes after.
That's everything right now.
Okay, so let's start where the sources do, with the emotional temperature of the market, because it is screaming a very, very loud number at us right now.
It really is.
We're talking about the Fear Greed Index, the F&G.
Yeah.
For anyone who might be a bit newer to this, can you just break down how it works and what this reading really means?
Sure. I mean, think of it like a thermometer for investor psychology. It's not just one thing. It pulls in data from all over market momentum, volatility, social media chatter, trading volume.
The whole 9 yards.
Yeah, and it crunches it all down into a single number on a scale from 0 to 100.
0 being extreme fear.
Total panic, and 100 being, extreme greed. Complete euphoria, which is usually a sign that a top is getting close.
Okay, so where are we sitting on that scale right now, based on the source?
We are deep in the panic zone. The current reading is 15.
15 out of 100, wow.
Yeah, and that's not just fear. The index explicitly defines that as extreme fear.
So what does that mean in practice? It means people have moved past, what, rational calculation?
Completely. This is pure, raw panic.
15 is. That's profoundly low. Let's really unpack what that looks like on the ground, on the trading floor. The sources detail 3 specific, observable signs of this level of panic.
Right. The first one is the most obvious. Widespread, just indiscriminate panic selling. People are just hitting the sell button.
And a flight to safety.
A flight to what they see as safety. So cash, stable coins. They're not looking at charts. They're not thinking about fundamentals. They just see the price dropping and want to stop the bleeding at any cost.
And this kind of selling, it often just spirals out of control because of all the automated trading systems, doesn't it?
Oh, absolutely. That's the second characteristic, and it's purely mechanical. It's the massive activation of stop losses.
So it's hang on.
Exactly. A mass cutting of losses. As the price falls and breaks through these well-known support levels, all those preset stop orders just trigger automatically.
Without any human even touching a button.
Right. And that mechanical panic, it pushes the price down way faster and way further than just organic human selling ever could. It creates this feedback loop that makes everyone think the bottom is just, nowhere in sight.
That definitely explains the speed of the drop we just saw. And the third and final sign, it points to something much broader than just Bitcoin, right? It's a systemic issue.
It is. The third sign is a systemic withdrawal of liquidity. When fear gets this absolute, money doesn't just move around in crypto, it leaves the asset class entirely.
And we have numbers on that.
We do. Our sources confirm the total crypto market cap is down significantly, around 4.5%. But here's the critical part.
The altcoins.
The altcoin market cap, which they measure with the CMC20 index, is down even more. It's down over 5%, 5.23%.
I want to pause on that CMC20 index for a second. For anyone listening, that's not just a random number. What is CMC20, and why is the fact that it's dropping harder than Bitcoin such a major warning sign?
So the CMC 20 basically tracks the top 20 cryptocurrencies, but it excludes Bitcoin. Now, sometimes when Bitcoin sells off, you'll see capital rotate within the crypto ecosystem. People sell their alts and move into Bitcoin as a sort of relative safe haven.
Okay.
But when the CMC 20 plunges more severely than Bitcoin, it tells you that's not happening. Investors aren't just rotating, they're exiting the entire crypto market structure altogether.
It's a deep systemic risk aversion.
Exactly. It proves the panic isn't localized to just one asset. It's comprehensive.
So the immediate picture is, it's bleak. Widespread panic, systemic capital flight. But the history of this index, it offers this really tantalizing countersignal. I mean, historically, this is the exact moment when you're supposed to be brave.
This is the hope signal. It's the reason some of the most successful traders start getting very interested when the F&G hits 15.
So what does the historical data tell us about bottoms?
The sources are really clear on this. In previous market cycles, anytime the F&G index dropped below 20, the market was usually within, say, 2 to 3 weeks of hitting a really strong, sustainable bottom.
And the logic there is just, there's no one left to sell.
That's the simple logic. When everyone who was going to panic has already sold, the selling pressure just dries up.
So this score of 15, it suggests we're either at or just terrifyingly close to that point of maximum psychological opportunity.
Precisely. The market is emotionally oversold. The psychological fuel for a big bounce is absolutely there.
However,
and this is the single most important nuance that the sources really hammer home, extreme fear is not a guarantee that you are at the final bottom.
and this brings us to that critical caveat, the bull trap warning. This is where the experienced money really traps the impatient money. Can you describe how that trap works?
Yeah, think of it like a spring-loaded door. You have this extreme oversold condition. You have shorts that need to cover.
So a bounce is almost inevitable.
A bounce is almost guaranteed. And it's rapid, it's convincing. So buyers who were scared before, they rush in thinking, okay, the worst is over, I've timed the bottom perfectly. That's the hoey, that's the relief rally.
But the underlying structure hasn't changed.
Exactly. The macro picture, the midterm trend, it's all still weak. So the price rallies up, hits a key resistance level, and it fails.
And what happens to all those new buyers who just jumped in?
They become the fuel for the next leg down, for the rally.
The subsequent fall.
Right. When the price turns over and starts heading back down, all the stop losses from those newly trapped long positions start to trigger, and that adds a massive new wave of selling pressure on top of the already weak structure.
Which maximizes the downside.
It maximizes it, and it sends the price plunging down towards those deeper, true market-clearing support zones like 82.5K or 78K. The trap works because it successfully lures in just enough liquidity to then liquidate it on the way down.
This context is so vital. We know the market is primed for a bounce, but we also know that the market makers want to flush out as many people as possible before any true reversal. So the question is, does the technical structure justify the fear, or does it just justify the bounce? Let's check the cold, hard numbers. All right, moving past the emotion, let's get into the technicals, the plumbing of the market. Let's start with the short-term view, the 4-hour and the daily charts. The price right now is what, hovering around $87,000?
Yeah, right around there.
What's the overall trend structure telling us about the balance of power here?
Well, the trend structure it's decisively clear. And this is the first hard piece of data that really contradicts the immediate hope you get from that fear and greed index.
Okay.
BTC is in a clear, confirmed bearish trend. It's consistently forming lower highs and lower lows.
That classic fractal pattern.
Classic. It means every time the buyers try to stage a recovery and make a new high, the sellers step in earlier and with more force than last time. And every time the price falls, it breaks to a new lower low. It's a textbook definition of sellers being in complete control.
And now let's layer on the moving averages, the MAs. These are sort of the long-term momentum gauges, and being below them is a universal sign of weakness.
It is, and the alignment we see in the sources here is, frankly, dire.
How so?
The price isn't just under one MA. It's currently located under all four of the critical ones, the MA25, the MA50, the MA100, and the MA200. It's a multi-level confirmation of the downtrend.
Why is being below all four so powerful? What does that signal to, say, the larger players?
Because each of those MAs represents a different investor's time horizon. The 25 and 50 are crucial for your short-term and swing traders. When you lose those, volatility picks up. But when you lose the 100, and especially the 200, that's a signal that the momentum is bearish for long-term position holders, too. It tells you the trend isn't just a blip, it's entrenched. Any institutional trading desk looking at this chart just sees a textbook bearish setup.
Regardless of how cheap the price might feel subjectively.
Exactly. The chart is the chart.
And that visual confirmation is made even worse by the Bollinger Band's analysis. The sources mention the price is hugging the lower band. What's the implication of that?
So the Bollinger Bands, they define the typical range of price volatility, right? With the middle line acting as sort of a gravitational center, a target for mean reversion.
Right. Price usually wants to snap back to the middle.
Usually. But when the price is hugging or just sticking to that lower band, it signifies that the downward momentum, the luck band or selling pressure, is so overwhelmingly dominant that the market can't even manage a typical bounce back to the average.
It's just relentless.
It's a relentless, aggressive push toward capitulation with that lower band acting like a magnet pulling it down.
All right, now we have to address the most controversial indicator in this whole deep dive. The Relative Strength Index, the RSI. This is the indicator that's really fueling all the hope for this relief rally we're talking about. The sources gave some very specific readings. What are they, and what do the different periods, the RSI 6, 14, and 24, tell us?
Yeah, the granularity here is excellent. For hyper short-term momentum, we have the RSI 6 at about 25. The standard one, the RSI 14, is sitting around 30. And then the slightly longer one, the RSI 24, is at 33.
Let's break that down. Why look at a 6 versus a 14? What's the difference in strategy there?
So the RSI 14 is the standard, right? It's a good balance.
Yeah.
The RSI 6 is what very, very active traders use to gauge immediate momentum exhaustion.
Boy.
The fact that the RSI 6 is at 25 means that over the last, say, 6 4-hour candles, the selling has been virtually nonstop. And that exhaustion of the immediate selling pressure is the mechanical trigger for a bounce.
And all of these readings, 25, 30, 33, they're all firmly in what's considered the oversold zone, which starts below 30.
Correct. So we have a clear mechanical condition for a bounce. The price has just fallen too far too fast.
But, and this is the crucial part that I think people need to understand, to avoid the trap.
Yes. The sources really emphasize that while these levels are low, they do not yet show any signs of a strong technical reversal. There's no divergence.
Okay, let's unpack that distinction because it is so critical. What's the strategic difference between an RSI simply being oversold and an RSI showing divergence?
An RSI being oversold at, say, 25 or 30 just means a bounce is technically probable. It's a temporary condition because momentum is exhausted.
A quick fix.
A quick fix. Divergence, on the other hand, is actual structural evidence that the bearish trend itself is losing steam. For a bullish divergence, you would see the price make a new lower low.
Right.
But the RSI would fail to make a lower low. Instead, it would print a higher low. That tells you that even though the price is still dropping, the underlying selling force is actually weakening internally. It's losing power.
And we don't have that divergence yet.
We do not. So the market has exhausted its immediate downward momentum, but the underlying structure of the downtrend is still completely intact.
So the RSI is only screaming bounce, not reverse.
Exactly. This is the technical confirmation for the HOI, the relief rally part of the pattern. It sets the stage for a recovery, probably back toward that 89K to 92K range, just to alleviate that mechanical pressure.
But you have to see that low RSI within the context of the bearish moving averages.
You absolutely must. The bounce is likely, but the overall trend remains overwhelmingly bearish.
Okay, we've established the short-term picture. A confirmed downtrend, but a high probability of an immediate bounce because of the oversold conditions and the extreme fear. So let's zoom out. Let's go to the weekly chart. This is the time frame that really tells us about the structural health of Bitcoin.
And the weekly chart is, it's grim. It really validates the deeper risks that we've been talking about. The sources explicitly label this a downtrend, man.
A strong, sustained downtrend.
Yeah, this isn't just market noise. This is a structural realignment.
What are the visual cues on that weekly chart that confirm this kind of structural weakness?
It's about duration and conviction. The candle structure shows 3 to 4 consecutive red weekly candles. That's not a one-off event. That's persistent selling pressure over a multi-week period.
And the volume.
The selling volume is increasing as the price is dropping. That's a sign of high conviction selling. It tells you that big players are willing to unload huge amounts of Bitcoin even at these lower prices.
And just like on the daily chart, we're seeing the loss of major weekly support lines, which have so much more weight to them.
Exponentially more. Losing the weekly MA25 is a sign of weakness, but the price has also lost the weekly MA50. And losing the 50-week moving average, that's often the line in the sand for institutional portfolio managers.
It's the point where the midterm momentum is officially broken.
It forces a complete reassessment of risk. Once you breach those major weekly momentum lines, the path of least resistance is usually down.
So let's go back to the RSI, but on this weekly scale. If the daily is oversold, is the weekly RSI telling us that we're close to the ultimate bottom?
Not yet. And this is probably the single most concerning piece of data for anyone who's a long-term optimist.
Okay.
The weekly RSI is low, yes, which indicates long-term weakness, but it has not yet reached that critical 20 to 25 zone.
And why is that zone so important?
Because historically, that 20 to 25 zone on the weekly is where you see the major cycle bottoms, the true once-in-a-cycle capitulation events that set up years of strong returns.
So the fact that we're not there yet.
It implies that the market might still have more structural downside to explore before we achieve that true final capitulation.
We might be in the third act, but we haven't hit the climax.
I think that's a good way to put it. So where does Bitcoin find its last major line of defense on this weekly structure?
That would be the MA100.
Exactly. The price is currently approaching the weekly MA100. The sources estimate this critical zone to be somewhere between $82,500 and $85,000.
So if the market sells off after this relief rally, that MA100 zone is the ultimate test.
It's the ultimate test of the midterm structure. A failure there would cause immense psychological damage and would likely trigger that final leg down.
But there is one potential positive anchor deep down in the structure that's giving long-term holders a tiny bit of hope.
The MA200, the big one. The sources make a point to say that the weekly MA200 has not been penetrated yet. Chua beatsianthum.
And if that holds?
If that deepest line in the sand holds, it suggests that the multi-year bull thesis might still be intact. You could view this whole period as just a massive, painful drawdown within a much larger structural uptrend. But again, you have to survive the MA100 test first to even worry about that.
All right, understanding that weekly chart lets us accurately map out the critical battlegrounds. For you listening, these numbers are strategic. They're where capital is either positioned to defend the price or sell it aggressively. So let's clearly define those key support and resistance levels from the analysis.
Yeah, this is essential for any strategy, whether you're trading or just accumulating. Let's start with the strong support levels, the floors that have to hold.
The highest one has already been touched, right?
It has. The first strong support level is $86,000. And the sources note that this is where we saw some immediate buying volume butt day appear. It suggests this is a temporary accumulation zone.
But the real test is whether it holds on a retest after the release rally fails.
Exactly. And if 86K gives way, we enter that territory of potential structural collapse, which links right back to those weekly moving averages.
Which brings us to the next level down.
Correct. The next critical level is $82,500. This is a confluence zone. It lines up really closely with that weekly MA100 we just talked about.
So losing 82.5K would be a major breakdown.
A major breakdown of the midterm trend. And if that fails, we're looking at the final deepest support zone, $78,000.
And hitting 78K would be...
That would represent true market clearing capitulation. It would likely coincide with the liquidation of almost all the leverage positions that were built up over the last quarter.
Okay, so those are the floors. What about the ceilings? The strong resistance levels that need to be broken to signal any real change in trend.
Any relief rally is going to run headfirst into these ceilings. The first major hurdle, probably where a lot of recent short sellers have placed their orders, is $95,000. Clearing that would be significant.
And then you've got the huge psychological barrier.
Absolutely. The next level is $100,000. I mean, crossing that would be a huge psychological win and probably trigger another wave of short covering.
But the highest technical resistance mentioned is the most important one for confirming a real trend change.
It is. That's $104,000.
And why is that number so critical?
Because it coincides almost exactly with the weekly MA50. Remember, the price lost the weekly MA50 on the way down. To confirm that the downtrend is truly broken, BTC doesn't just have to cross 104K, it has to hold it as support. Until that happens, any rally is technically just a bounce inside a bearish market.
So this is where we connect all the dots. We've got the extreme fear, we have the mechanical oversold conditions, and we have a strong bearish structural backdrop. When all of those forces meet, what's the logical conclusion?
The confluence really demands a very specific immediate action from the market. When you have extreme fear, that F&G score of 15 aligning perfectly with an oversold RSI of 25 to 30, the market just cannot continue to drop in a straight line.
It's mechanically impossible almost.
It pretty much is. The mechanics of short covering and quick bottom fishing, they necessitate the creation of a temporary bottom, a staging ground.
And the sources mentioned that buying volume is showing up around that 86K level. Is that enough to confirm this temporary bottom?
It absolutely reinforces the idea. The sources specifically noted buying volume, badai, is appearing around 86K. This isn't just passive waiting. These are aggressive buyers trying to front-run the bounce.
So that volume plus the exhausted RSI.
It makes the immediate technical bounce a very high probability event.
Okay, so putting it all together, what is the most probable pattern forecast from this professional analysis?
The forecast is the Huirai model, the relief rally and subsequent fall.
Okay.
The expectation is for a sharp rebound, the Hui, back towards that immediate resistance zone, likely topping out somewhere between $89,000 and $92,000.
In that rally, it only serves two purposes.
Only two. First, to relieve the oversold RSI condition, and second, crucially, to lure in new, hopeful long positions.
So the relief rally is basically just a technical formality. It's not a structural reversal.
It's a technical necessity within a bearish frame. That's it. Once that bounce happens, if the price fails to reclaim significant structural resistance, and 95K is the big one, the underlying weakness, fueled by those deeper macro factors, is expected to take over again.
And that's the ray.
That's the row, the continuation of the downtrend, targeting those market clearing levels of 82,500 or even 78,000.
So the danger for anyone listening is mistaking this temporary price action for a long-term trend change. Describe the maximum risk of getting caught in this bull trap.
The risk is amplified. I mean, if you're a long-term investor, you might see the F&G at 15, you see the oversold RSI, and you think this is it, and you buy into that initial rally.
Right.
But if that rally fails to hold, you haven't bought the bottom. You've just bought into the market's attempt to reload short positions. You become the exit liquidity for the smart money.
You become the fuel for the next move down.
Exactly. The market needs those long positions to get trapped so that when they are liquidated on the way down, they provide that final massive wave of selling pressure required to hit the true capitulation zone.
It's a psychological and technical chess game. And this next move, the bounce, is designed to make the final checkmate move even more effective.
That's the perfect way to describe it. The extreme fear is the tinder, the relief rally is the match, and the drop that follows is the inferno that clears out all the weak hands.
Technical analysis is fantastic, but, price doesn't exist in a vacuum. We have to anchor this volatility to the external forces that are acting on the market. Let's look at the negative drivers first. The pressure from above that justifies this bearish structure we see on the weekly charts.
The primary negative driver, without a doubt, is global monetary policy. It's tying the crypto market directly to traditional risk-off sentiment. The sources highlight that the Federal Reserve is maintaining a hard stance.
Laptrong kanan.
Right. And what a hard stance from the Fed means in plain English is that they are not expected to pivot to aggressive interest rate cuts anytime soon.
So higher for longer.
Higher for longer. The message is that liquidity will remain expensive and tight, and when central banks are pulling liquidity out of the system, high-risk, high-volatility assets like Bitcoin always suffer disproportionately.
And that stance from the Fed, it has a direct knock-on effect on two other key indicators mentioned in the sources.
Yeah.
The dollar index and bond yields.
Exactly. Tighter monetary policy leads to rising U.S. Treasury bond yields. Now, why does that matter for Bitcoin? Because those bonds offer a safer fixed return.
A risk-free rate.
Right. If suddenly your risk-free assets are offering attractive returns, institutional money flows out of high-risk assets like crypto and into the safety of bonds. It's a direct competition for capital.
And the strengthening U.S. dollar index, the DXY, just reinforces that flight to safety.
It does. When the DXY is strong, it signifies a global risk-off environment where investors all over the world are seeking the absolute safety of dollar-denominated assets. And since Bitcoin is priced in dollars, a stronger dollar makes BTC comparatively more expensive for international buyers, which just dampens demand even further.
So the Fed's rhetoric is the main structural headwind. What about the internal market dynamics that are adding to the negative pressure?
Well, we can't forget the natural cycle of profit-taking. You have people who are securing gains after the last upward cycle, and they're using this volatility as their exit window.
And then there's the systemic risk we talked about earlier.
Right. That plunge the altcoin market cap, the CMC20 being down over 5%, it shows the panic is widespread, and it's compounding the selling pressure on Bitcoin as capital just rushes for the exits.
Okay, so despite this overwhelming negative pressure, there have to be drivers for the expected relief rally, and maybe some anchors for a longer-term optimistic view. What are the countervailing positive drivers noted in the sources?
Well, the most immediate positive drivers are the purely mechanical ones we've already covered. The RSI at those extreme lows of 25 to 30 is a powerful, almost non-negotiable trigger for a short-term reversal. No asset can just drop that violently forever without some kind of mechanical correction.
Sentiment just perfectly backs up that mechanical signal.
It does. The F&G at 15 is, by definition, in the reversal zone. This level of absolute pessimism means the market is basically running on empty in terms of available sellers.
So any little bit of good news,
Or even just a lack of bad news, or a small pocket of positive volume can trigger a sharp, violent snapback as all the short sellers scramble to cover the positions before that anticipated bounce happens.
Now, we did establish that the weekly MA50 and MA100 are lost, which is very bearish, but you said the MA200 is still holding strong.
And that is the ultimate long-term structural defense. The fact that the weekly MA200 has not been penetrated is the single most significant positive structural sign on the chart. It suggests that despite how vicious this midterm bear market is, the very long-term, multi-year bullish thesis could still be viable,
Provided that line holds.
provided that ultimate line in the sand holds firm.
And finally, let's just quickly revisit the altcoin season index. If altcoins are plunging, why would an index reading of 27 out of 100 be considered a positive driver?
It's a subtle point. That index measures the flow of capital and interest. A reading of 27 while it's low means that capital has not completely abandoned the riskier end of the crypto spectrum.
Okay.
If that index were near zero, it would signal total capitulation, zero interest in risk-taking. At 27, it shows that there is still some specialized capital, some investor appetite, just waiting on the sidelines for a signal. It provides a small buffer against a total market collapse.
So our synthesis really remains this fight between the short-term inevitability, the bounce driven by RSI and fear, and the midterm structural reality, the confirmed downtrend driven by the MAs and this relentless macro pressure.
It's a moment that demands extreme precision and emotional control.
Yeah.
The market is trying to shake out every last we can before it potentially decides on its true long-term direction. We're watching a structural test of the highest order.
As we bring this deep dive to a close, let's synthesize the crucial takeaways that you need to navigate this high-stakes environment. You have the full map now, the psychological breaking point, the technical triggers, the structural red flags, and all the external pressures.
Okay, so first, the trend is confirmed. The downtrend is clear on both the short and midterm charts. We have lower lows, the price is below all the major moving averages. This is a bearish market structure, and any rally you see is inherently risky.
Second, the sentiment is at its absolute extreme. Market psychology is defined by extreme fear, 15 out of 100. History suggests this is the zone where bottoms form, and it provides the mechanical fuel for a rebound.
Third, because of those oversold RSI conditions, that 25 to 30 reading, a technical bounce or a relief rally, probably towards that 89K to 92K resistance zone, is highly likely in the immediate future. That bounce is an internal market mechanism that just has to happen.
And finally, the structural risk remains overwhelmingly high. Despite that probable bounce, the relentless macro environment, the Fed's hard stance, rising yields, a strong dollar, it all suggests that the most likely move after that rally is a continuation of the downtrend to test those deeper support levels of $82,500 or even $78,000.
The relief rally is the trap, not the reversal. And this confluence of data, where you have extreme risk balanced by this historical opportunity signal, it forces a really critical psychological choice. The technicals can give you the numbers, but the decision is entirely yours.
We've established the RSI is oversold, fear is tinder dry, suggesting an immediate move up is imminent. But we've also confirmed the structure dictates the ultimate direction is likely down to clear out those final weak hands. And this raises a really important question for you.
When fear is this absolute, where do you draw the line between strategic caution and full capitulation? Do you see the technical bounce up towards 92K as the biggest short-term opportunity to grab a profit? Or do you see it purely as the biggest risk of 2025, and you wait for what might be the true structural capitulation down at $78,000?
Your decision really hinges on whether you believe the psychological extreme outweighs the macroeconomic reality.
That is the essential trade-off defining this exact moment in the market.
Something to mull over as you watch those charts move. Thanks for joining us for this deep dive.